The stock market is in correction mode. Some people would even say the stock market is crashing right now. What are we to make of the entire market as we head closer to the FOMC statement on Wednesday? In this video, we're going to talk about what you can expect from the FOMC statement that comes out, plus the presser that follows. We're also going to dig deep into the S&P 500. We're going to look at historical pullbacks. We're going to look at what the potential is for a far more significant pullback than what we've even seen so far. The best case scenarios, the worst case scenarios, we're going to dig into all of that. But first, make sure that you're pounding that like button, subscribing to this channel, and getting notified of all my future videos. We're doing live streams. We're doing multiple videos each week. And make sure to click on that join button down below so you can become part of the YouTube membership and get all of my market research each and every day. There's a lot to be concerned about with the stock market going forward, but nothing's going to play a bigger role than what the Federal Reserve ultimately decides to do. And we're going to get a good idea of that when they provide us with their FOMC statement and their stance on interest rates. Now, the expectation is that it's going to be a 50 basis point rate hike. But is there a possibility for 75? Yeah, there's some people out there that think that there could even be a 75 basis point rate hike. Is it the likelihood? No. But I actually think that there is a decent chance for it because for so long, the Federal Reserve has been way behind the curve. And what better way than to lower the expectations a little bit, have people settle into the idea that it's only going to go up by 50 basis points, and then surprise them with a 75. That would change the narrative a little bit to where people are saying, okay, the Federal Reserve is finally taking this serious. Jay Powell is trying to get ahead of inflation. A 75 basis point rate hike would do that. 50 basis point rate hike is expected, and possible that we even rally off of the news of one, because it's already, for the most part, priced into stocks. But even beyond the FOMC statement, the question and answer session that comes about 30 minutes after the FOMC statement comes out is also going to play a huge role, because he can say things that really rile the markets. So that you understand, I think there's a possibility for a 75 basis point rate hike. Do I think it is expected? No. More than likely, it's going to be 50. But if they really want to send a message to this market, get interest rates back up to 1%, then hiking the interest rates to 1% would be a huge move and show signs to the rest of the market that Jay Powell is actually serious for the first time ever. Now, let's get into the charts. We have the S&P 500. We're going to use the SPY ETF. We have this declining channel that is in place, and we're not going to focus on it for too long, but I do want to point it out just so that we have a reference point. It actually looks like today we tested the bottom of this channel and bounced, almost broke below it, but instead we bounced, had a solid intraday reversal in the final hour and a half of trading. But does that set us up to go right back up to this upper channel band? Well, the previous rally, this one that started off with the March 14th low, started a day or so before the FOMC statement came out. And then you had the FOMC statement the day after, and it really catapulted the market right back up to this upper channel band. Now we're about a day out from the FOMC statement. Could this be the start of another rally that takes us right back up to the upper channel band?
Oh,
Even if it is, I don't expect this rally to sustain. It will be another dead cat bounce, just like what we saw on March 14th. It'll also be like the ones that we've seen thereafter and those from before. Also, when I zoom out, you still have this massive head and shoulders pattern in play. Left shoulder, head, and right shoulder. Yes, this is part of the head too. We thought for a while that might actually be the right shoulder, but no. Left shoulder, head, right shoulder, and then you have the neckline that goes all the way across. And we actually broke below it and closed below it on Friday, but just as we have seen so many times before, it rallied right back up above it today, and now it is back above that head and shoulders neckline. Taking a look at the weekly chart, again, head and shoulders pattern very pronounced. And the other point that I want to bring up, it shouldn't be overly surprising if we do bounce. I still remain short on the market, but I've took some profits on Friday, looking to possibly take some more profits throughout this week if this rally wants to continue. It shouldn't surprise us, though, if it does continue, because we've seen so many times in the past where there's been a 4-week sell-off followed by a significant bounce thereafter. Doesn't necessarily mean that the sell-off is over, but more times than not, a 4-week sell-off will result in a market bounce thereafter, at least for a week or so. The only times where it didn't was back in 2011. We sold off for 8 straight weeks. But the degree of selling on many of those weeks were not that significant. That lasted from April through June of 2011. The other one happened in 2008 during the Great Recession. We sold off for about 6 weeks. That lasted from June to July of 2008. But even in September of 2008, when the market was seeing some of its greatest amounts of selling that it's ever seen before, it sold off for 4 weeks. You take the sell-off that happened in March of 2020. The worst sell-off lasted 2 weeks. Actually, the whole thing only lasts for like 4 or 5 weeks. And then the 2018 sell-off, you didn't have anything that went beyond 3 weeks. So we're at 4 weeks now. Good chance we see a bounce, but I don't necessarily expect that bounce to hold. Now let's get into the most interesting part, and that's the monthly charts here of the S&P 500. Let's start drawing some Fibonacci retracement levels. This is the Fibonacci retracement level going back to 2020, going all the way back up to the highs that were established back in December, January of this year. So far, we've had a little bit more than a 23.6% pullback. Most of your pullbacks will either be of the 38.2 nature right here, or the 50%. Real significant ones will pull all the way back to 61.8%. That would be pretty bad, but would also line up with the highs from 2019. So now that we've seen that the 23.6% level isn't holding, there's a good chance we're going to eventually come back to this 382 level on SPY. And that's if we're just using the Fibonacci retracement off of the 2020 lows. The much bigger rally goes all the way back to the 2009 bottom from the Great Recession. At that point, we haven't even come close to hitting the 23.6% retracement level. In fact, under this scenario, it gets far worse. We're talking about 322 or even somewhere around 274. Now, I know a lot of you guys are saying, it's like, Ryan, you're never going to see a pullback that bad. It doesn't happen. This market's too good, it has too good of fundamentals. That's what people said during the dot-com bubble, even though it didn't. That's what people said during the Great Recession. That's what people have said pretty much in every kind of market pullback. Why? Because the very fundamental basis of a market wipeout is the fact that nobody's expecting it. Otherwise, it wouldn't really happen because everybody's already expecting it. The very fact that you get these sell-offs is because no one's positioned for it and they take massive losses. If that wasn't the case, then they wouldn't be taking massive losses and the market would figure out a way to price it all in. But that doesn't happen. You have to have market corrections eventually, and when they do, it wipes out a lot of people. But it provides an excellent reset for so many traders that are patient and wait for the great opportunities that can come out of them. Now, let's look at, from a historical basis, some of these other big market pullbacks, and where did they pull back to? Here was the one from March 2020. Saw a pullback to this 38.2 level. In fact, had it not been for the Fed coming to the rescue, I think this one could have gone all the way down to 61.8% retracement. But the Fed came to the rescue. They did emergency rate cuts. They did a whole bunch of stimulus programs. You had PPP coming out. You had money just being printed everywhere. And so it put a bottom into this market, even though it was an artificial bottom. Then you take the sell-off that happened from 2018. This was a massive sell-off. We saw this 23.6% level hold quite well. And again, it was reversal in Fed policy that put in an artificial bottom and sent it right back up to the March 2020 highs before it pulled back again. So you're starting to see a theme here. The Fed has consistently bailed out the market. But the one thing they didn't have to deal with back then was inflation. Right now they do. So if they bail out the markets, guess what happens? Inflation runs higher. Less people can afford housing, less people can afford everyday items, and they aren't willing to let that happen. At least it doesn't appear that way when he has said repeatedly that he's willing to vulgarize the economy. Now let's go way back in time here and go to the dot-com bubble. Guys, look at this time. What a time to be alive this was. Where did we pull back to? We pulled all the way back to the 61.8% level. That's what happens when you actually let the market take its course. There's a possibility that we could see a 61.8% correction, and it would provide unbelievable opportunities if you manage the risk with your current positions along the way. And eventually, it did bounce as well. Now, you might have noticed I skipped over the Great Recession. Why is that? Well, that was a little bit of a different animal all into itself. This one gave back all of its gains and more. This one went way beyond the 100% retracement level and gave back all the gains that it made off of the dot-com bottom. So, the takeaway in all this. Yes, I do believe that there is a potential bounce in the short term, and it wouldn't surprise me if it happened this week. There's a lot of history that suggests that going beyond 4 weeks is very difficult. There's been some exceptions along the way, like what we talked about in 2011 and 2008. But by and large, it's very difficult to sustain sell-offs beyond 4 weeks before at least getting a short-term dead cat bounce rally. From a long-term perspective, I think that any of these dip buying opportunities that come along before the markets finally bottom is just going to lead to more pain for the dip buyers and their portfolio. They're just loading up to create more pain for themselves because the very essence of buying the dip automatically and without thought for the bigger picture is what you call an undisciplined trader. And there's a lot of undisciplined traders out there right now, and they're hurting, and they see right now as their opportunity to get back into the market to try to salvage whatever they have left of their portfolio. They look at their portfolio and they say, if I don't buy right now, I will never get this money back. So they see this as a desperation attempt to get the market to go back up, rather than whether or not the market actually wants to go back up and go back up to all-time highs. And let me just tell you this too. There's a lot of people on Wall Street. There's a lot of people trading in this market that have never seen a bear market, not a real legitimate bear market. They don't know what it's like to trade through a 2008. They don't know what it's like to trade through a 2000. It is brutal. It goes deeper than you'd ever imagine. And whether or not we're about to experience that, we're going to find out here very soon. If you enjoyed this video, make sure to like and subscribe to this channel. And by clicking that join button down below, you're going to get access to all my market research that I provide members with each and every day. So check it all out. Let me know down in the comments below, what are your plans for this market? Are you getting stopped out? Are you going short? Are you starting to buy the dip here? I want to hear about it. I want to debate you in the comments too. I like hearing different opinions. I'm fine with that. Thank you guys, and God bless.